Welcome to Market Day Report. Let's jump into the markets and we'll start with the corn market. What's happening? We're in lower territory. Front month is up a half penny, but it's the December we're watching. That's the new crop down 437 and a half. Soybean trade, what are we seeing there? Well, the beans down 22 at 1039 and a quarter. Wheat market has been moving higher. July, Chicago, 527 and a half. It's 2 3/4 cents higher. Hard red, July, both of those are new crops, 523 and a half. It's a half penny higher. And then the December for spring wheat is the new crop here, 608 and a half. It's a half penny lower. That spring wheat December contract has been lower 6 consecutive sessions, so we'll try to break that losing streak today. Cotton market is lower as well. 65-cent cotton on the old crop. That's what's already in the warehouse, if you will. But December, which is new crop, one that's in the ground or going in the ground, 67.87, down 38. Let's go to Chicago. Vice President, Zaner Ag Hedge, Ted Seifried. Okay, Ted, it's not looking too good right now.
Yeah, these are what we call mixed markets, Tony. Corn and wheat really wanted to be higher on good export sales numbers, on the recovery of that collapse in the July-December old crop, new crop spread that we've seen. It went from a large inverse to a carry briefly. Now we're back to a little bit of an inverse again. And these are kind of good things happening for corn and wheat. But in the meantime, you've got soybeans down very, very sharply. That is stemming from, as I'm sure you guys have talked about, soybean oil being limited down overnight. And that's based on the EPA outlook for 2026 as far as what we're going to use or what will be mandated for biomass biofuels. I think that the trade had gotten well over its skis on what to expect from the EPA. Obviously, this is a bit more of a reality check. I'm also going to say that soybean oil had gotten very overbought. Maybe wasn't quite, in my opinion, justified to getting to some of the levels of the sharp rally that it's been having over the past 5 or 6 sessions. So I don't know if this is a thing where soybean oil just goes straight down from here. I think it needed a bit of a correction. We're just doing it all at once, and it started in a low volume night session. But it's certainly having an effect as far as being really heavy on the soybeans here today. We've virtually taken back all of the gains, most all of the gains, let's say, from the cooling of the trade war and from the bullish USDA report for both old crop and new crop soybeans. So now we're kind of sitting where we're at it. And I've said it before. I think the soybean fundamentals might be really rather friendly longer term, but I'm not so sure that they're really rather bullish short term. And if we extend lower, if we close down here or lower today and then extend it lower into tomorrow, that's going to look like a major head fake on a chart.
Well, there you go. We've got you back
Very quickly.
Yeah, I lost you there for just a moment.
Sorry about that.
You're spot on there, and again, had a chance to see that chart pop up as well, looking at the November new crop beans and the new crop corn there as well. Hey, Ted, hang on. We'll take a quick break. We'll come back and talk about volatility in the livestock market. Market Day Report continues in a moment. Just been watching where the hogs have settled here over the last few sessions. 3 sessions in a row moving higher. Then yesterday, the hog market settles lower. And where are we today? Lower again. 102.42 is where we hit the high on the July contract, but we're really closer to the low now at 101.62. That July contract is off 82. But again, I guess I'm somewhat impressed that we're holding on to the $100 range for July and August. But look what happens after that. You get to October and December, and you take $15, $16 at least off that August contract. Okay, let's look at markets that are dealing in some, heavy volatility this week. Feeders, 298.45 on the August. That's down 352. 367 lower on September and October, down 390. And the live cattle market, we saw a spike yesterday and then gave back those gains and finished in the red. August 207.57, down $1.80. Where's the volatility coming from and what's happening? Ted Seifried with Zaner Ag Hedge. Thoughts here?
Yeah. I'll start with the hogs. There's not a ton of volatility in the hogs. Like I said, we cooled it off a little bit yesterday. We are down a little bit today, but for the most part, holding the bigger gains that we have seen since Monday, Tuesday, the gap higher that we had on Monday. And that would make a lot of sense because a cooling of a trade war with China is a really good thing for hogs because pork exports, that is probably the biggest winner, really. Because of the time of year, really, soybeans could be the bigger winner longer term, but for the here and now, it really might be pork. So that makes about as sense. And like you said, holding on to that 101 in the front months, or holding the $100 level. And to your point of the deferred months being quite a bit lower, that's a nice bull spread there. I think that's a good look for the market. You can expect that unless there's a dramatic change in fundamentals, that those back months will catch up over time. So I think it's a good look for the hogs. For cattle, yes. I mean, a lot of volatility. Volatility a lot of times is indicative of extremes in markets. In the case of cattle, obviously, it's been a long-term bull market. And when you have an outside reversal down day, i.e. key reversal, and a key reversal that closed below the gap in those August feeders, that's a pretty bearish sign on a chart. And when you have a massive fund position, these are technical traders. They go running for the doors. And I'm going to say, I think a lot of this is sparked, first of all, by lower box beef prices, and there might be a bit of a cooling in domestic demand. But really, there's concerns about what happens if that New World screwworm is or does come into Texas and comes into the States. Some people suggesting that it might already have happened, and what that might mean for the market. So, there's fear. And so the last 2 days are a good reflection of what fear can do to a market that is very heavily on one side from a speculative perspective, and then those speculators go running for the doors. So I think that volatility will continue. That's sort of the nature of markets that have been in long-term and mature bull markets.
Ted, always great to have your insight there. And you're right, fear kind of underline that. Ted Seifried with Zaner Ag Hedge in Chicago.